Welcome to The Sound of Economics, the podcast series by Bruegel, the Brussels-based economic think tank. I'm Giuseppe Porcaro.
I'm Alicia Garcia Herrero.
And today we will talk about the reopening of China after COVID-19. This episode is part of Bruegel's focus on global China as seen from Europe, which includes our monthly newsletter ZhōngHuá Mundus, link to subscribe in the show notes. I'm happy to host Stephen Ying, who is joining us from Hong Kong. Stephen is founding managing partner of High Impact Capital Advisor, an impact financial advisor specialized in providing non-bank financial institutions with private capital while enabling faster progresses towards the United Nations Sustainable Development Goals. Hi, Stephen. Thanks for joining us.
Good morning to you, Giuseppe. How are you? And good morning, good afternoon to Alicia too.
Indeed, you're both in Hong Kong, and I would like to tell to our listeners that Alicia, she is in a very special place in this moment. She's on a ferry boat, in between Hong Kong coastline, right, Alicia?
Totally, and this is why I'm in silent mode, and I'm a little bit slow in taking the silent mode out. Sorry about that, but I don't want to disturb Stephen. I know he has very interesting stuff to tell us, so I'm going to indeed put myself in silent and come back to you with a little bit of delay.
Absolutely, but your voice is really clear, so I think that we are really good in terms of setup. Perfect. So
Wonderful.
Let's go into the topic. As China moves ever closer to fully re-emerging from 3 years of government-imposed COVID isolation and reintegrating with the world, economic expectations are quite high. Beijing's recent pivot from its stringent zero-COVID strategy, which had long choked businesses, is expected to inject vitality into the world's second-largest economy this year. COVID lockdowns and border curbs have left China out of sync with the rest of the world, disrupting supply chains and damaging the flow of trade and investment. And with the global economy now facing significant challenges, including energy shortages, slowing growth, and high inflation, China's reopening could provide a much-needed and timely boost, as well as some challenges. In the initial phase, we have seen a wave of COVID cases unleashing. However, the peak seems to have passed. Therefore, it is perhaps time to look at what the reopening will mean for the economy, for the society at large, and for the relation of China with the rest of the world, and other related aspects, such as energy consumption and the overall predictability of China's behavior in the short to the longer term. Stephen, can you help us navigate first on the overall picture? What will China's economy look like in 2023 after the reopening?
Well, thank you for the question. Seemed like a lot to unpack.
Absolutely.
I appreciate the opportunity to have a conversation with you, Giuseppe, as well as Alicia. As you might know, the Chinese New Year 2-week holiday just ended about 2 days ago. Everyone feared the second wave of COVID didn't quite materialize during the holiday period. To people in China and Hong Kong, that was not too surprising because back in December, and we all seen unprecedented COVID wave hitting almost 80% of the entire population of 1.4 billion Chinese people all at once. So pretty much the whole country has built up this immunity before the Chinese holiday. So the fact that we all travel, meaning my compatriots, my friends, my family, all travel during the Chinese New Year, and the foot traffic is back, vehicle traffic is back, train traffic is back, tourist traffic is back, and back almost to the pre-pandemic level. Now, that said, traffic back is not the same as economic back. In fact, we believe a Chinese economy recovery will be a slow one. I'm not an economist, but I can tell you the Chinese economic recovery doesn't look like a V shape, maybe not even a U shape. Whatever the shape, my feeling is based on my conversation with our clients, customers, it looked to us that 2023 will be a two-gear recovery. First 6 months will be slow gear. Maybe the second half of the year, you will be moving to a higher gear. We see initially investment, manufacturing will experience modest and faster growth. On the other hand, export continue to slow, maybe bottom out towards the second half of the year. Nevertheless, the consumption and the service will be much, much slow to recover. It's not a brain surgery because if you look at the low employment in the country, if you look at the low wage, these are lingering effect of the scar of the COVID. That will take much longer time to recover. Also, another factor coming to play. If you look at even before 2022, China money supply has been pretty loose. In fact, if you look at last year, the money supply grew 10%. Economy only grew 3%, right? And that faster money growth has not triggered higher price in both asset price and service goods price. That's very unlike in the advanced economy, like US, for example. US, the overall economy maybe not that going that fast, but asset price has gone much faster. That just tells me something's not right about Chinese economy. So the stimulus, losing monetary policy so far has not worked. Maybe another factor coming to play. When I talk to my friends, seem like this is a common trend that household balance sheet is shrinking. So people are talking about asset savings, like 1.52 trillion US dollar built up during the COVID. But my friends tell me that they're not ready to spend or invest. And they might use their money most likely to pay down the debt, like, for example, mortgage. So all in all, I have a mixed feeling about the economic recovery. Definitely not V-shaped, maybe not U, much slower, especially in the first half. The second half might be, we see improvements. So.
Thank you, Stephen. I would like to call in Alicia and comment on that because, Alicia, you've been also writing about the situation. We've been also discussing about the economic prospects for 2023 in another podcast here at The Sound of Economics. How do you compare your notes with what Stephen just told us?
So first of all, Stephen and I have been comparing notes only recently, and it is quite impressive that, from his investor's perspective and mine, which is basically based on checking data, very, very different way to look at things, we get to the same conclusion. This is, and I would add, the fact that China's recovery will be slow, ironically, is actually not such a bad thing, either for China or the world, because if, say, the Chinese government were to push a much faster recovery just for the sake of, basically proving themselves. Yeah, I mean, like, we're out and it's going to be massive. That would only generate inflationary pressures because basically the factories aren't ready, the industry isn't ready. I mean, you need time. We've learned that in Europe, it creates inflation because not everybody will be back to work. Not everybody will be ready to spend. This is more on the consumption side. So I think it is good in a way that we don't have that massive pent-up demand and that we don't have that massive growth. Again, not only for China, because the last thing you want to have now in China is a further reduction of real disposable income because of inflation. You do not want that. And let alone the world, we do not want inflation coming from high energy prices pushed by China's stratospheric growth. So what Stephen said to me is absolutely on point. Most importantly, is absolutely fine, which is the irony of things. If not, 2024 would be terrible because you would have a huge cliff and very negative base effect for China, and it would be so hard to grow. A little bit like 2022, by the way, because of very high growth in 2021. So I think overall, totally in line with my thoughts. Most importantly, totally in line with what I hope will happen for the sake of everybody.
So, Alicia, we're going back also to the issue of prices and inflation in a while. But we've been zooming pretty much on the domestic situation. But you mentioned that, of course, there are some implications also for growth and inflation around the world. I would like to perhaps remind that a resurgence in China's pent-up consumer and investment activity could support global demand. Good exporters and popular Chinese tourist destinations, particularly across South Asia and East Asia, might benefit. A surge in bookings on travel websites points already to a potential recovery in global spending by Chinese tourists, which in 2019 was around $255 billion US. However, the news of the reopening has been received with mixed feelings, especially in those countries that started to fear another global COVID wave. Meanwhile, China's reopening is also not completely, because it has been so far selective and tourist visas have not been issued yet by Beijing. How, Stephen, do you see the impact of all this at the global stage? And linked to that, since you are based in Hong Kong, how do you see cities like Hong Kong and to a certain extent also Shanghai rebounding internationally again?
Right. In terms of Chinese and Hong Kong tourists going abroad and the visa restrictions, in my opinion, by and large, that's fake news. I'll tell you why. The news media like to take one story or one example and try to exaggerate and generalize as a trend. So that can be very misleading, in my opinion, because my family, we took a week and a half vacation between Christmas time and the New Year to visit Niseko, Japan, skiing. And we saw a lot of Hong Kong people congregate there, very crowded, and some Chinese. While we in Japan, the headline news read, Japanese government banned Chinese tourists and Hong Kong tourists. We went to Niseko, landed in the Hokkaido airport, and we left Hokkaido. When we finished our skiing, we left the Hokkaido airport, no problem. Okay, so I think we need to be mindful or careful when we're reading what's being reported. Tourists is an important factor, but I will mention there's something else was not very much discussed in the media. Maybe is even bigger contributing factor to global economy. That is Chinese students studying abroad. For the last 3 years, because of COVID, many of those Chinese students had to stay home, take distance learning or online courses instead. What's different this year is that just before the holiday, the China Ministry of Education announced a huge announcement that any online degree will no longer be recognized in China, which means those Chinese students who study enrolled abroad had to go attend their classes in person on campus. Otherwise, their degree would not be recognized in China. So we are seeing maybe upwards of 600,000 or 800,000 Chinese students will resume traveling abroad, attending their classes in person on campuses. It has two factors. One is obviously, they're going to spend. Not all those Chinese students are spoiled. So some of them may have to go to work, like in the restaurants, hotels, or make deliveries. So that also could contribute to the labor shortages, ease that labor shortage in the events economy, or maybe also help out with the wage pressures. So that's the other factor I think we might want to consider. In terms of people come to China, it is true. A lot of friends telling me that for the last 3 years they had not visited China, and they don't miss it. Okay, there's some like that. So in this case, for me and my friends, we visit them. So I have scheduled a business trip to Bangkok to attend a business conference in first week of March. And then I will be in London, Amsterdam, Oxford for the Easter, right? But for some people, I think they would love to come back. I'm not worried about Hong Kong because some of my friends, they might immigrated to Singapore during the COVID, but now they're coming back. They maybe have different reasons. My take is that there's only one place in Hong Kong that you could buy almost anything and sell everything with a transaction with very little government interference. So you could question about Hong Kong's political freedom, but no one questioned Hong Kong's free market. So I guess what attracted people to come to Hong Kong is the animal spirits. Shanghai is not that far behind, because just you look at Hong Kong, like myself, I'm a Shanghainese, and many people in the upper echelon of government and business, I'm not one of those, but they are all from Hong Kong, from Shanghai too. So Shanghai has a slight difference between Hong Kong is that it still requires 3 PCR tests before flight. So that kind of bothers people. So if that is gone, I think slowly, surely, the traffic will come back. But as I said before, traffic does not immediately equate economic rebound. Traffic will come back first.
But Stephen, just a follow-up question before Alicia's might comment on what you just said. I mean, you are in Hong Kong, and you mentioned about Singapore. I also traveled to Singapore 2 months ago, and I've seen a lot of Hong Kong-based investments or people being moving or moved there. So you see this as a temporary fix because of the COVID restrictions that will be somehow reversed, and Hong Kong will get back on its foot? Or do you see a larger, longer-term trend of Hong Kong losing its own ranking, let's put it like that, within the global cities of that part of the world?
Right. Unscientific polling among my friends, roughly about 30% are coming back to Hong Kong from Singapore or considering coming back. I'm talking about those who have moved to Singapore. Mm-hmm. And the common reason is boredom. Because Hong Kong, there's always people like the messiness. It is messy, chaotic, but there's attractiveness to messiness and chaos too. What people concerned about losing of political freedom, the risk of that in Hong Kong, and they seek shelter and safety in that. But over the time, I think the market dynamism still remain in Hong Kong. That remain attractive to some people, not all, but some. Yeah. So I don't see one-sided. Everyone moved to Singapore all of a sudden.
Right.
I've not moved. I could if I can. Yes, if I want to. Sorry.
Alicia, your take on this?
The thing is, what I'd like to come back to in this interesting discussion about Hong Kong, Shanghai, Singapore, what is clear to me is that if the reopening, as you said, Stephen, will be for those who can actually talk about Hong Kong, Singapore, and Shanghai. You see what I mean? Like, that's where it's starting with business people realizing that there are huge opportunities, sectoral opportunities, restoration, hospitality, traveling. We actually estimated only domestic traveling contributing 0.5 percentage point to 2023 growth. So, if basically to get to a number 5 to 5.5, I mean, from 3, you're doing 1/5 of that only through domestic traveling. So, first of all, the recovery is easy, but it's not coming from the middle income class. It's not coming from even lower than that, because there we know for a fact that they've suffered, that their disposable income has been stagnating for 3 years. So what I think is going to happen is that the business is going to come back. They're going to see the opportunities, and this, corridor, Hong Kong, Shanghai, but even Singapore, will work. And Hong Kong, by the way, which was again in recession, -3% in 2022, again, will thrive this year. But for the mainland, again, going back to Stephen's point, to really have sustainable growth of the like that they are used to, it's going to take a long time. The scarring is there. And this is why, although the authorities are not really talking about anything but growth and, as they say in France, vive le secteur privé. Yeah, it's like back to the private sector. And Li Chan, and we had this conversation with Steve, is surely the right person to do that. Having said that, there's still this lingering problem, which is income distribution, having worsened enormously in China in 2022 for obvious reasons. Even before, it's the whole COVID period. And that's why I think the kind of the phantom, if I may say, of common prosperity, the phantom that income needs to be redistributed, that there has to be a public sector that does something about this, is still there in the mind of the entrepreneurs. And therefore, I would say that, yes, there's going to be recovery, but it's going to be quite staggered across different sectors and across different social classes, indeed. And the worst of all, and this brings me to the very interesting comment that Stephen made on students, I think is key. Not only are they being pushed. Wait a minute, I want to say something that has some I would say not geopolitical, a little bit like of a not an economic reasoning behind only, or education reasoning, that they are asked to if they want to get a degree to leave. It's because there's no jobs for them, Stephen. There's no jobs for them. So if they actually, as we pointed out, leave for the US, they solve a problem there, but they also solve a problem in China. And this is why we need to think about this social scarring that will take time to recover, in my view.
I would like to go back, Alicia, on the issue of prices, though. Not just consumer prices, but in terms of raw material, copper, iron, and other metal prices which are exposed to China's property sectors have recently rallied. And meanwhile, with China accounting for about 1/6 of the global oil consumption, some forecasters now project that prices could push back above $100 a barrel in 2023. In Europe, there may be implications for energy supply. Last year, the EU was able to build up gas reserves despite Vladimir Putin's closure of the major pipelines. largely by importing liquefied natural gas. As Chinese LNG demand returns, prices might rise and competition for gas will intensify, which could leave Europe with shortages for next winter. So many analysts think that if China's rebound keeps energy prices elevated, or as it was said before, if China's rebound is going to be too fast, inflationary pressures, that's exactly your point, Alicia, from before, may take longer to wind down, and central banks could be forced into tightening monetary policy even more. So perhaps we could break down these three interrelated questions, trying to make it simple for our listeners because they are quite complex issues, and having this look into the impact of the reopening on trade, inflation, and energy, and how they interrelate. Maybe we can start with global trade, if Stephen could add something to this picture.
Sure. The first, what seems to me on the inflation side, the price of goods, physical goods, may be peaked. It's not the same story on the service side. So recently, when we make a booking for the airline tickets, the hotel booking, price still remain at the very elevated levels, right? And the fact that they are very expensive, and Chinese tourists go, traveling, that wouldn't help the situation. But on the other hand, we talk about Chinese students going aboard that maybe increase the labor supply. That might alleviate the situation in the medium term. Right. The other factor had to come into consideration. That's the U.S. dollar, a stronger U.S. dollar, because all the commodity are priced in U.S. dollar. So we cannot deny that strong U.S. dollar doesn't have any effect in that. As China reopens and the manufacturing pick up, I think the Chinese goods could, the Europe politicians might consider to let cheap Chinese goods come into the Europe to help to alleviate or offset higher price in other areas, whether it's commodity or, let's say, in service sectors. So these are the things, I guess, dynamics, moving pieces will play into the global trade and the price. The other two factors, maybe not as frequently mentioned, is on the investment side. And a lot of people talking about decoupling of investment and the trade. And we see one area are recoupling, such as EV sector, electrical vehicle sectors. For example, Hungary. Hungary actually has a very large auto sector, maybe 20-30% of the GDP. And as the industry shift to electrical vehicles, obviously it requires lots of battery capacities. Who are building the battery factories in Hungary? Koreans and Chinese, because the largest battery manufacturers are Chinese and Koreans. So there's some area decoupling in investments, but other area are recoupling, right? And for the area I'm familiar with, the European investing in emerging market and Chinese markets. And in the last couple of years, I see a dramatic shift in private debt, like debt financing. My clients used to pay maybe 4%-ish on private debt to the European investors. But going forward, like we're looking at this year, without increasing any risk, same in clients, we're mostly likely to pay 2% more, 6%, because faster anticipated growth of economy in China 3 versus 5 years, for example, and also the lower hedging costs. So all in all, I think it's a mixed picture. Yeah.
Alicia, do you want to add something on this, but especially maybe on the consequences on the inflation, which you were mentioning before?
Stephen is, of course, in a much better position to understand where investors are coming from as regards China. But of course, even impact investment is, even if there's anything that is going to suffer from higher funding costs, that's obviously impact investing. But what we know from looking at, even high yield, even real estate, high yield real estate, we can see already that both the reopening, but especially the lifting of government restrictions, such as the 3 red lines, but even beyond, making it easier for people to buy housing, is having an impact, an improvement in the cost of funding. So I would say that as we move on, I would imagine that this growth that it will be generated, it won't be massive, I agree with you, but of course, certainly better than 2022, will actually have a kind of a soothing impact on funding costs in China.
And today, the third aspect, I would like at least a comment on the energy prices, what to expect there, because indeed there is this story about the gas and the fact that we in Europe have been somehow thanking China to be closed for this extended period of time while we were struggling with our own reserves amidst the Ukrainian war. What to expect over there? Is that a real threat that we need to brace in Europe, or do you think that market will stabilize in any case?
Maybe are coming from the angle of what implication on China vis-a-vis the oil, gas, etc. For Chinese energy composition, coal has always been number one in terms of proportions, followed by oil and renewable. Renewable including hydros, by the way. And the smaller portion is the gas, natural gas, including LNG. 2021 was exceptional because Chinese had purchased record amount of natural gas. That I'm the commodity person, but the numbers out there for everyone to read seem to me it's highly correlated to the weather. 2021, China suffered the worst drought in recent memories. So all the hydro generation outputs way down. So they have purchased the record amount. But 2022, last year, that was 2021 what I was referring to. 2021, the purchase, the demand for gas had come down. In fact, the overall demand, if you look at the national statistics, went down by 1.4%. And they were able to divert, especially the American LNG back to Europe, because thanks to Donald Trump, they had struck a trade agreement, so locked in these long-term purchases. And because of these become surpluses, they were able to divert that to Europe. And by the way, if you look at where the sources of the natural gas, LNG, by far majority are coming from Australia, the closer neighbors, followed by US and then Qatar. So we're talking about above 60 to 70% are coming from Australia. So in terms of price on oil and natural gas, China and Europe are on the same page when it comes to because they're all importers and they want to buy at the lowest price possible. On the other hand, we see the source of import of the oil and natural gas. China has been more diversified. That's number one than some other countries. The second point is that if you look at the expected increase of import for the natural gas this year in China, it's all because the new contract, long-term contract, kicks in. So China really rarely buy from the spot market. So majority of their supply all derived from the long-term contracts from these very diversified sources. Therefore, it will be very seldom China and Europe will be locked in a bidding war for the same supply.
Thank you, Stephen. Alicia, maybe a last word on that, because that's a very, very important point. And also, if you can say something about decarbonization as well, if what we can say on that as well.
Yes. So basically, I think Stephen's point is that, and this is a structural point. Yeah, I mean, China basically does not play, to speculate, or at least certainly not for gas and oil. I mean, these are long-term contracts. In some cases, prices are struck, at the bottom of the cycle for many years. We had the example of Venezuela in 2008. I mean, there's many others. So basically, naturally, the competition is not as obvious, okay? And then, by the way, we're already seeing a big increase in coal again this year, because China realizes that it's not in China's interest to push up gas and oil prices. It's just against its interest. Beyond that, and this is brings me to Russia, because of the cap. I mean, there's basically a dual market. And China is not in our market. China is in its own market with India, mostly with India, also Indonesia. But I mean, these are the big buyers. So it is very hard for China, if I don't think China wants to do so, but basically to influence the marginal price if China, as in many ways, either has long contracts or is buying oil from Russia at discount prices. So what I'm saying is it's not only about the economy, which, by the way, both Stephen and I agree that won't be like exuberant, but more importantly, the market structure, I think, should not put us there. But I want to finish with a point, because this sounds all very positive. China exports as much as 35% of global intermediate goods. So inflation might not come from energy, but it could come from China's export prices into our supply chain. And I'm not saying that China would do this on purpose, but just imagine if there's some supply disruptions in China because maybe workers don't come back. I don't think that's what we are seeing. To be frank, it's just a tail risk. But that tail risk, in my opinion, is more important than energy, and we're not focusing on that.
Thank you, Alicia. We don't have so much time left for this episode, and I know that we could discuss for much longer because all these issues are all interrelated and bring to, as Alicia has been just mentioning, to other issues which are even bigger than that. But obviously, we keep those conversations open in our podcast series and on our publications. And that is all the time we have for these episodes. And I would just like to remind that this was part of Bruegel's focus on global China as seen from Europe, which includes as well our monthly newsletter, ZhōngHuá Mundus, to which we invite you to subscribe. The link is in the show notes. As usual, you can read in open access all the analysis by our scholars on our website, www.bruegel.org. Stephen, Alicia, thanks a lot for joining this conversation, especially Alicia doing this from a boat. That was perhaps a primer for Bruegel, Sounds of Economics. And thanks to all our listeners for tuning in. And I would just like to say goodbye to everyone and until next time.
Thank you.
Thank you so much. Thank you. Thank you, Stephen. Thank you, Giuseppe.
Bye-bye.
Bye.